Welcome back to Finance Pro Tips channel. Today we're deep diving into stocks. Just before that, please click like and subscribe. It really helps YouTube algorithm. Stocks in general are a fundamental component of the financial markets, representing ownership in a company and providing a means for individuals to invest in and potentially profit from the success of businesses. This comprehensive guide aims to demystify stocks, explaining what they are, how they work, and their role in personal finance and the broader economy. Let's go deeper. Number 1. What are stocks? A stock, also known as a share or equity, represents a fractional ownership in a corporation. When you purchase a stock, you are buying a small piece of that company, entitling you to a portion of its assets and earnings. Types of stocks. 1. Common stocks. These are the most prevalent type of stocks. Holders of common stocks have voting rights in shareholder meetings and receive dividends, which are portions of the company's profits, although dividends are not guaranteed. 2. Preferred stocks. These stocks typically do not offer voting rights but provide a higher claim on assets and earnings than common stocks. Preferred stockholders usually receive dividends before common stockholders and have a higher priority in the event of bankruptcy. Number 2. How stocks work. Stock markets. Stocks are traded on stock exchanges, such as the New York Stock Exchange, NYSE, and the NASDAQ. These exchanges provide a platform for buyers and sellers to transact stocks in an organized manner. Stocks can also be traded over the counter, OTC, in less formal environments. Initial public offering, IPO, when a company decides to go public and offer its shares to the public for the first time. It does so through an initial public offering, IPO. This process involves the company issuing new shares to raise capital from investors. Once the IPO is complete, the shares are traded on the open market. Trading stocks. Stocks can be bought and sold through brokers or online trading platforms. The price of a stock is determined by supply and demand dynamics in the market. Factors influencing stock prices include company performance, economic conditions, market sentiment, and geopolitical events. Number 3. Why do companies issue stocks? Companies issue stocks primarily to raise capital for growth, expansion, and other business needs. Here are the main reasons why companies issue stocks. 1. Raising capital. Issuing stocks allows companies to raise substantial amounts of money without having to repay it, as they would with a loan. This capital can be used for various purposes such as expanding operations, developing new products, entering new markets, or improving infrastructure. 2. Debt reduction. By issuing stocks, companies can reduce their reliance on debt financing. This helps in lowering interest expenses and improving the company's debt-to-equity ratio, making the company financially healthier and more attractive to investors. 3. Liquidity for founders and early investors. Issuing stocks can provide liquidity for founders, early investors, and employees who own shares. By going public, these stakeholders can sell some of their shares on the open market and realize a return on their investment. 4. Acquisition currency. Publicly traded companies can use their stock as currency to acquire other businesses. This can be done through stock swaps, where the acquiring company offers its own shares as part of the payment for the target company. 5. Attracting and retaining talent. Companies often use stock options and equity incentives to attract and retain talented employees. Offering employees a stake in the company aligns their interests with those of the company and its shareholders. 6. Enhancing visibility and credibility. Being a publicly traded company can enhance a company's visibility, credibility, and prestige. It can lead to increased recognition, trust, and confidence from customers, suppliers, and partners. 7. Diversification of ownership. Issuing stocks helps in spreading ownership among a broader group of investors, which can lead to a more stable and diversified shareholder base. This can reduce the risk of having a few large shareholders exerting significant control over the company. Number 4. Benefits and risks of investing in stocks. Investing in stocks offers a variety of benefits and risks. Understanding these can help investors make more informed decisions and manage their portfolios effectively. Benefits of investing in stocks. 1. Potential for high returns. Historically, Stocks have offered higher returns over the long term compared to other asset classes like bonds or savings accounts. This potential for capital appreciation can significantly grow an investor's wealth. 2. Dividend income. Many companies pay dividends to shareholders, providing a steady stream of income. Dividends can be reinvested to purchase more shares, compounding returns over time. 3. Ownership and voting rights. Owning stocks gives investors a share in the company's assets and earnings. Common stockholders often have voting rights, allowing them to influence major corporate decisions. 4. Liquidity. Stocks are typically highly liquid, meaning they can be bought and sold quickly on the stock market. This provides flexibility for investors to enter or exit positions as needed. 5. Diversification. Stocks provide an opportunity to diversify an investment portfolio across different sectors and industries, which can reduce risk. Diversification helps mitigate the impact of poor performance in a single stock or sector. 6. Inflation hedge. Over the long term, stocks have generally outpaced inflation, preserving purchasing power. Companies can often pass on higher costs to consumers, protecting profits and stock prices. 7. Tax advantages. Long-term capital gains, profits from stocks held for more than a year, are often taxed at a lower rate than ordinary income. Additionally, qualified dividends may also receive favorable tax treatment. Risks of investing in stocks. 1. Market volatility. Stock prices can be highly volatile, fluctuating significantly in response to economic data, political events, company news, and market sentiment. This can result in substantial short-term losses. 2. Business risk. Companies can perform poorly due to factors like management failures, competitive pressures, regulatory changes, and industry downturns. Poor performance can lead to declining stock prices or even bankruptcy.
3. Economic risk.
Broader economic conditions, such as recessions, inflation, or changes in interest rates, can negatively impact stock prices. Economic downturns can lead to widespread losses across the stock market. 4. Liquidity risk. While most stocks are liquid, some small-cap or less-traded stocks may have lower liquidity, making it harder to buy or sell shares without affecting the price significantly. 5. Dividend cuts. Companies may reduce or eliminate dividend payments during tough financial times, reducing the income stream for investors relying on dividends. 6. Inflation risk. While stocks generally outpace inflation over the long term, high inflation can erode purchasing power and negatively impact consumer spending and corporate profits in the short term. 7. Concentration risk. Focusing too heavily on a single stock, sector, or market can increase risk. If the concentrated investment performs poorly, it can have a significant negative impact on the overall portfolio. 8. Psychological risks. Behavioral biases, such as overconfidence, fear, and herd behavior, can lead investors to make poor decisions, like buying high during market euphoria or selling low during panic. Number 5. Analyzing stocks. Analyzing stocks involves evaluating various factors to determine their potential for investment. There are two main approaches to stock analysis: fundamental analysis and technical analysis. Here's an overview of both methods and their key components. 1. Fundamental analysis. Fundamental analysis evaluates a company's financial health and performance to estimate its intrinsic value. This method involves examining various financial statements, ratios, and economic indicators. Key components of fundamental analysis. Financial statements. Income statement shows the company's revenue, expenses, and profits over a period. Key metrics include revenue growth, net income, and earnings per share, EPS. Balance sheet provides a snapshot of the company's assets, liabilities, and shareholders' equity at a specific point in time. Key metrics include current ratio, debt-to-equity ratio, and book value. Cash flow statement tracks the cash generated and used in operations, investing, and financing activities. Key metrics include operating cash flow and free cash flow. B. Financial ratios, profitability ratios, measures a company's ability to generate profit. Examples include gross margin, operating margin, and return on equity (ROE). Liquidity ratios assesses the company's ability to meet short-term obligations. Examples include current ratio and quick ratio. Solvency ratios evaluates long-term financial stability. Examples include debt-to-equity ratio and interest coverage ratio. Valuation ratios helps determine if a stock is overvalued or undervalued. Examples include price-to-earnings, P/E ratio, price-to-book, P/B ratio, and price-to-sales, P/S ratio. C. Growth potential, analyzing past performance and future growth prospects, including revenue and earnings growth rates and industry trends. D. Competitive position, assessing the company's market share, competitive advantages, such as patents, brand strength or economies of scale, and industry position. E. Management and governance, evaluating the quality and track record of the company's management team and board of directors. F. Economic and market conditions, considering the broader economic environment, including interest rates, inflation, and economic growth, as well as industry-specific trends. 2. Technical analysis. Technical analysis involves studying historical price and volume data to predict future stock price movements. This method relies on chart patterns, technical indicators, and statistical measures. Key components of technical analysis. Price charts. Line charts shows the closing prices over a specific period. Bar charts displays the open, high, low, and close prices for each period. Candlestick charts, similar to bar charts but more visually detailed, showing the open, high, low, and close prices. B. Chart patterns. Trend lines. Lines drawn to identify trends, support, and resistance levels. Patterns. Recognizable shapes on charts, such as head and shoulders, double tops and bottoms, and triangles, that signal potential price movements. C. Technical indicators. Moving averages smooth out price data to identify trends. Common types include simple moving averages, SMA, and exponential moving averages, EMA. Relative strength index. RSI measures the magnitude of recent price changes to evaluate overbought or oversold conditions. Moving average convergence divergence, MACD, shows the relationship between two moving averages to identify momentum changes. Bollinger Bands uses standard deviation to create bands above and below a moving average, indicating volatility. D. Volume analysis. Volume trends. Analyzing trading volume to confirm price trends and detect potential reversals. High volume on price movements often indicates strong investor interest. E. Support and resistance levels. Support. A price level where buying interest is strong enough to prevent the price from falling further. Resistance. A price level where selling pressure is strong enough to prevent the price from rising further. Many investors use a combination of both fundamental and technical analysis to make informed decisions. Fundamental analysis helps identify fundamentally strong companies, while technical analysis can help determine the best entry and exit points. Analyzing stocks requires a thorough understanding of both the company's financial health and market behavior. By applying fundamental analysis, investors can gauge the intrinsic value of a stock, and through technical analysis, they can time their trades more effectively. Balancing these approaches allows investors to make more comprehensive and informed investment decisions. Number 6. Stocks and the economy. Economic indicators. Stock markets are often viewed as barometers of the economy. Economic indicators such as GDP growth, unemployment rates, and inflation can significantly impact stock prices. Positive economic news can drive stock prices higher, while negative news can lead to declines. Market sentiment, investor sentiment, or the overall attitude of investors toward the market can drive stock prices. Bullish sentiment indicates optimism and can lead to rising stock prices, while bearish sentiment indicates pessimism and can result in falling prices. Stocks play a crucial role in personal finance and the broader economy, offering individuals the opportunity to invest in businesses, and potentially reap significant financial rewards. Understanding what stocks are, how they work, and the benefits and risks associated with investing in them is essential for making informed investment decisions. Whether you're a novice investor or an experienced trader, a well-rounded knowledge of stocks can help you navigate the complexities of the financial markets and achieve your financial goals. Thanks for watching. If you found this video helpful, please give it a thumbs up, share it with your friends, and subscribe to our channel for more personal finance tips. Leave a comment below with your thoughts or any questions you have about stocks. Until next time, and enjoy stocks.